All right, so got about 40 of you guys in here today. That's good. So what I wanted to do here this morning is just to put a little perspective on things, calm down a little bit, help you guys calm down a little bit. I know many of you have been following what we've been doing in the room, and most of you, hopefully all of you, but at least most of you, have been taking a very slow step back approach. If you've been watching what I do, what I've been doing, that's been my approach here. So as a result, am I feeling sick or ready to throw up or disgusted or frustrated this morning? No, because as you saw, I dumped a lot of stuff last week, Wednesday and Thursday, and even parts of Friday, and just decided to stay with some index puts, and I have some index calls as well too that are going to go probably to zero today or next couple of days. We've been talking about this for the past couple of weeks, and something happened on, I want to say it was a Thursday, the 20th, right? Something happened on this day that caused things to fall. Now, you know me, I'm not a top caller. That's not my game. But you got to do a post-mortem, which means you've got to look at what happened and try and understand it and figure it out. So the next time the markets get hit like they are currently right now, you'll be ready and prepared and looking for the same type of signals. Because remember, these patterns don't change. We're all, as I talked about in the seminar yesterday in Brooklyn, we're all on the same spectrum of fear and greed. Every single one of us, all 7 billion people on the planet, okay? So that doesn't change. We're all fearful about losing money and we're greedy about making more money. Everybody is. I don't care who you are. So that being the case, we can look at behavior and, you know, this candle is a behavior, this candle is a behavior, this one is a behavior. Everyone is a human behavior based on where they are in their emotions and their minds, and they react a certain way. Now, is it always rational? No. The irrationality of decision making by the crowd creates opportunities for you and I. Okay, so you know, big drops like we're going to have today, seemingly irrational, right? And they will eventually, if you've been, and I'm going to harken back to what I started with. If you've been playing it cool and playing it light, maybe bouncing around a few puts, bouncing around a few calls here and there, just for the past few weeks, but keeping very high levels of cash, then those opportunities from the irrational behavior of the markets are going to fall right into your lap. Okay. I mean, this isn't anything different than what we saw in 2008, 2009. However, I remember those times, especially late of 2008, September, October, November. Of course, we all remember Lehman Brothers happened on my dad's birthday, September 15th, 2008. And not long after, we had AIG, and then Merrill Lynch was down hard, and then they got bought by Bank of America. But my point here is this, is that during that nosedive of the markets and rise in volatility, there were endless calls of, this is the greatest buying opportunity of your lifetime. You've got to get in, yada, 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 okay? Well, maybe in the long run, that advice was good, that was right. But certainly in the short run, it wasn't good advice, okay? So what we have here is this: we have a market that is responding to major panic right now. The worst thing you can do is to succumb to the advice of others who just say, oh, just just jump in there and buy. Now, if you're a long-term buyer, you're a long-term investor, and you're looking at a time horizon of 20 years, 30 years, perhaps even more, some of you, great buying opportunity. I would agree with that. Okay. So pick off some of the best names that you can, buy a little bit here. Again, those are for the longer term stuff, but short term, intermediate term, it's an exercise of knife catching. Okay. And I don't know of anybody who is really good at knife catching. I do know that anybody who tries it often ends up with bloody hands. It's not anything that you can prepare for, or not anything you can perfect. It's not a skill that is rewarded at all. Okay, if you're wearing iron gloves, sure, you can, but good luck trying to catch those knives if you're doing that. So all that said, I want everybody to understand this is not a time to panic. I think all of you know that. I think if I would look at all of your faces right now, I'd probably see a lot of shock and a lot of horror and a lot of, oh my God, what do we do here, right? So I'm here to tell you, you got to sit back and wait, let this whole thing play out. If you've got some positions, I know some of you do, and you know what that's going to hurt, that's going to be painful. If you've got some time on those things, I don't think it's necessary for you to bail out yet. All right. So I hate to utter these words, but there is going to be a big rally. Okay. There is going to be a big rally coming soon, I suspect. All right. But once we get through all this panic and all this bad stuff going on here and all the selling, there's going to be a good buying opportunity. Now, is it going to be anything more than a bounce? Leanne and I were talking about this yesterday. Probably not going to be more than a bounce. That's probably all you're going to see. A little bit of a bounce back up. It's going to look strong and powerful only to the extent that the oscillators are extremely stretched again. As you recall, back on that Friday, I want to say it was the 28th, when we hit that low of 28.55 on the S&P, the oscillators got stretched back as far as I've ever seen it. Now we may get back there today, maybe worse. I don't know. If we get another down session tomorrow, my goodness, that'll be they'll have stretched that rubber band all the way from here to China. So that snap back is going to be pretty vicious and pretty strong. But right now, we can see the chart has all the selling has inflicted a ton of damage on the chart on the S&P 500 in a very, very short period of time. We may be opening down over here, 2,800, possibly even lower than that. I see the VX, the volatility futures are up 16 right now. That's about 30% from the close on Friday. More than that, actually, almost 40%. Oil is down almost $10. We did get below $30. We all heard the news over the weekend that the Saudis have decided to flood the market with oil. It's not only going to hurt the Russians, because that was their main objective, main goal. It's also going to hurt U.S. suppliers across the board, right? So I would also caution you that to look at these drops here today, and as much as tempting as it may be to maybe buy an Exxon down $5 or a Chevron down $10 or an Oxy down $3-4 into the 20s. The yield's pretty nice. In fact, Oxy's yield is probably going to be about 14%, right? They're going to cut that dividend eventually because they're not going to be able to sustain that with oil prices as low as they are. And I don't suspect that with the actions of OPEC and the Saudis, that oil is going to bounce back very much unless they do some sort of surprise deal, okay, with the Russians or whatever. So Um, so what I would say is just step back, just watch things for a little while. If you've got some positions that you think you need to unload here, go ahead and do it. Raise some cash. You guys already have probably raised a lot of cash in your accounts over the last couple of weeks, and kudos to you for doing that. But you know, we're in extraordinary times right now, and this is not a good time for you to be risking capital on stuff that you have no control over. You're gonna get whipsawed. Okay. So anybody who might have added some puts last week, I did quite a few. Leanne had a good idea. Let's talk about rolling those puts out, right? Or even creating some put spreads, right? I don't suspect there's going to be much of a recovery today. Okay, so if you, let's say, you know, I mean, I'm in some of these SPY 300 puts and 295. I bought some 290 puts at the end of the day, towards the end of the day on Friday. They may open up pretty nicely, but they were already elevated, so I'm not going to get like, you know, an 800% return, whatever. But that's okay. I think the objective here is to take your risk down, right? What happens when puts increase in value in your account? Your risk levels increase, right? Because what happens to your account? Your account goes up, and the percentage of the position in puts rises as well too, right? So let's say you had some let's say you bought some 290 puts in it, and you bought them at, you know, $3 or something like that, and then go up to, let's say, 10, 12, I don't know, whatever the case may be. All right, you want to sell those and roll them down, maybe to, and keep some of that protection on, right? The most important thing is to sell. Do some selling. Do something that will put some cash back in the account, so you're ready for the next move. And what I often do is I told everybody on this webinar a couple months ago. I told everybody in the seminar yesterday. The first thing I do is I sell something. Whether it's 1, 2 contracts, whatever. I just get myself in the mode of selling. Okay, that way I can't keep letting the day go by and say to myself, oh, I want to sell, but I can't do it. I've already done it. I've already done something. Okay, whether it's a loss or a win or whatever. Just sell something at the open. That's what I do. I mean, you don't have to do what I do, but I mean, that's my whole thing. Sell something at the open. Just get it out of the way. Get myself focused and ready for the next 6.5 hours, because I'm probably going to want to sell something later on that day, right? So another thing, you know, let's say you've got that itch that you really need to get long something that's tanking today. Maybe it's a Microsoft down $10. Maybe it's Nvidia down $25 or something like that. You know, you don't have to expend a ton of capital here, right? If you really need to buy something, Leanne's going to laugh at this one. Just buy one share. Just buy one share, 2 shares, whatever. Okay. So Nvidia is $250, $240, right? Just buy a share. Just buy one share. Okay. And just feed that ego, not ego, but feed that desire to buy something and to get in and to say, okay, I picked something at the bottom. You know, we're not bottom pickers over here, right? But you can get yourself in some really hot water by expending too much capital out there and thinking that, okay, I've got this thing nailed. Believe me, people thought that last week, and they're crying the blues today. They thought they nailed that bottom last week. Saw lots of people out there saying that, okay, this is it, we're turning up, yada yada yada. And it turned out, you know, I mean, listen, I was getting long stuff on Monday and Wednesday, thinking the same thing. But you know what? We never followed through. We turned tail. And I said, oh, well, that was wrong. So, you know, that moving to the side and then buying some puts. That's what we did on Thursday and Friday, right? Remember something, as I mentioned in the seminar yesterday. There's nothing wrong with being wrong. It's okay to be wrong. It's not okay to break the rules and to make mistakes like that. Okay? So making mistakes like sizing wrong or jumping in trying to grab a falling knife when we all know that's the wrong approach. That's the wrong thing to do, right? Like adding on to a losing position, or just recklessly throwing capital out there on trades that you think are going to work, that you might get lucky on. All right. In this condition, in this situation, in this market environment, we're going to have to rely on luck. Well, yeah, sure, absolutely, right. But we're not trying to time the market here. That's the point here. We're not trying to time the market. I'm not going to tell you that this is the bottom down over here. Okay, could be. There's a couple of gaps down here. There's a gap over here. There's a gap down. We filled a gap down over here last week, or a week and a half ago. But I'm going to tell you that in an emotionally charged market like we're in right now, none of these levels are meaningful at all, right? Well, we can drive through it like a hot knife through butter. All right. And you might sit there wondering, oh my God, what did I do? Right. And then you're sitting there with losses, and then you turn into a hope and pray mode, right? Let's not go there, right? Let's have our wits about us. Let's be a little bit smarter than most people. We're not making predictions here. I think what the best thing to do, if you've got some puts, roll them down, keep some puts on, sell some puts underneath if you want to do the spreads. Okay. So in other words, if let's say you have a 290 put, and let's say it opens up at 275, whatever, and now your put from $3 or $4 goes up to like 15. You can sell a 280 put, probably catch a lot of that premium out of there, and have a net winner. You can't lose. Keep that trade on if you want. You're not going to really increase your capital. You're not going to really increase that trade, right? But at least allows you to keep that trade on and put some cash back in the bank. Does that make sense? That's not the number one trade that I would do, but it's probably, on your list of 2 or 3 or 4 different options that you have. Obviously, let's review some of those. You can do nothing. You can sell all of your position if you have a nice gain. You could sell half. You could roll it down. You could sell a put underneath if you have a nice strong put winner, and take in some of that premium, right? You could certainly buy a call that's cheap and then wait for the upside, but I wouldn't do that. That's strangling it. We already know volatility is up, so if you have long puts, or a long strangle, you're already playing for a volatility move, and you've already gotten that volatility move. So what's going to happen is with the VIX up to 50, 51, 52, volatility is more likely to contract than it is to go higher. Now, that doesn't mean it can't go any higher, but I'm saying that more likely the probabilities, the odds favor VIX to come down. And why is that? Well, let's look at previous volatility spikes on the chart here. Okay. This was last week, and we popped up and popped right back down again towards the end of the day. Let's look at the chart here. Here we go. All right. So we had a spike here last week. We had a spike here in early 18, came right back down again. We had a spike here in 15, came right back down again. 11 came up and came back down again, and of course, financial crisis up and came back. So you see the drill. You see what I'm talking about, right? Volatility doesn't go to the sky, and people end up, we hit these relative strength levels. So again, but what I'm telling you is, don't get sucked in and buy this first huge dip here today. Okay, there's going to be a time where the turn is going to be there for you, and you're going to be able to see it. You're going to see some opportunities, right? So just step back a little bit and watch what's going on. We have been having monumental moves down in gold. Oil, up in bonds. TLT is up huge. We see yields down to record levels now. Gold's up a little bit. Masum is asking, would you recommend any gold today? I don't think so. I think gold is going to look to be a source of funds. I think you got a clue last night Gold was over 1,700, but couldn't hold it. So I would say probably pass right now on gold. I think gold's going to come back to about 1650 on the chart. That's where it was looking at for me, and then probably be another buying opportunity right down there. Okay. Any questions from anybody? Please, this is it right now. I've got 5 minutes, 6 minutes to answer your questions. Go ahead and let me know what's on your mind. If anything, anybody's bothered by anything. Also, I'll be here all day as I usually am, but I will open myself up to if you have anything personal you want to talk about, anything market related, trading related, investing related, go ahead and ping me on the side. I will take some time and talk with you. Hopefully get you, if you have any issues or any problems, hopefully we can walk through it together and get you through it. But anybody have any questions? One thing that somebody reminded me of. So last week's webinar we talked about jumping in and saying, putting in some bids underneath the markets for some stuff. Why not do it again? Why not try it over there again? If you're sitting on some cash and there's something that you wanted to get into, maybe throw a wild bid in on Apple. Apple's down $20. Why not throw it in there for $235, $240? Maybe you'll pick up some shares there. Maybe I see JP Morgan down at $98, right? It's a 2.5-year low, right? Let's take a look at that chart for a minute. JP Morgan's a great bank. It's not going anywhere. But it was 138 just a couple of weeks ago. Now it's down under $100, down below the August lows. Let's see. Let me look at the weekly chart on this one, for instance. So, yeah, we're below levels from 2019 over here. Well, not quite. Right over here, we're going to be probably opening at 90. 200 moving average is at $96. We could certainly make a run to that. Why not throw in a bid to buy some JP Morgan at say 94 to 96 bucks, right? Underneath the market. How about again, Apple, right? I don't know where Apple's going to open up this morning. It looks like it's 260 something, 267. Why not throw in a bid to see if you can catch some at around here, 240, 245, right? Maybe 250. I don't know. Maybe let's see what else. Google, right? Google is closed 1295. Looks like it's may open up about 1210 today, right? 1210 is slightly above the 100-day moving average, 100-week moving average, excuse me. Throw in a bid at 1200, maybe 1195 or 1187 or something like that. So these are some things that will, these are some longer term plays. Obviously, you want to jump in there and grab into. Don't go all in on these things. What you want to do is you want to add a few shares here and there that get super cheap that you think that, there's just no way I can pass that deal up. That's great. Okay. Put in some bids underneath the market. Put a list of 4 or 5 stocks together in the next half an hour and put those in, put some bids underneath the market. Why not? Right? So, all right. Any questions from anybody? Nothing from anybody so far. Go ahead and type it in. I'm here for a few more minutes. Type it in, and I will answer your questions. I hope everybody's doing okay. I hope everybody had a good weekend. I had a great time in Brooklyn over the weekend. Met some really nice people. Had a nice session yesterday. 72 people there. Sold a few books and had a great time, and met Bob Murphy in the room and from the room there. And Tad, I'm sorry I didn't get a chance to see you. How about buying some leaps? Patty said, yeah, I think leaps are some of the leaps that we had on our list. So we added a few more on over the past couple weeks. Patty is a great idea. Add some leaps to this. And then look, if you're in these diagonals, these short calls are probably going to collapse in a big way. So why not buy those back and sell some more? Sell some more of those things a little bit, maybe a little bit lower. Maybe if you sold some April, May, or June calls against your leaps, buy those back and sell lower strikes, right? That's the way to manage those things. Yeah, Chris, that's what I was just mentioning about the leaps. I would, add some more, maybe sell some diagonals or something like that against them. John says you want to short some equities in particular. As we're washed out over here, John, not any particular names, I don't really think I want to put those out there. I would just probably stay short the indices or long puts on the indices as well. Rich says you discussed putting in some low bids on some good names with high volatility. Would you recommend the same of selling puts? Naked puts? No, I wouldn't. So here's an article from, let's see here, Mark Sebastian, right? He put this out there last Thursday. Everybody see this here? Bad as things are, he thinks we're getting towards the end of 100-point S&P 500 moves. Well, that was wrong. Once the smoke clears, this place go long. Well, that's wrong too. Okay. He suggested selling a naked June 19 250 put at $6. Well, this thing's going to blow out. This sucker is going to blow out today, right? Now we may not get near 250, but we're 265. This thing, I would not be shocked if this thing was at like $15 or $17 today. So anybody who had naked puts is going to get pummeled. Okay. Sal asked, should we continue to buy new long puts? Well, if you already have some puts, what I mentioned earlier in the webinar, roll them down. Roll them down. Don't be a sitting duck there. There's always a chance we could rally back here. The probabilities are low, but there's always a chance we can do that. So I always want to keep some protection on it, right? If you have some puts on, Sal, I'm sure you're not hurting today, right? I'm sure you're probably thinking, scratching your head on Friday as the markets rally back. Why am I buying puts? Why am I in puts? The market's oversold. We've gone down so much, blah, 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 right? But then you look at what's happening this morning, and I suspect you're happy you have some puts on. So, erratic price action, lots of fear, lots of selling going on. Keep your puts on. I know they're expensive. I know they cost a lot of money, but you know what? That's how insurance works, right? When the possibility of a major event is going to happen, and the time frame is short, which the VIX is basically 30 days of volatility. They're looking for a major event to occur. I don't know what it is over the next 30 days. The cost of insurance, the cost of price of puts is going to get expensive, right? If you have life insurance and you know you're going to die in 30 days, I suspect that life insurance is going to be extremely costly. Make sense? Okay. Any opinion on Regeneron? Glenn asked me about. Okay. It's been really super strong. I don't know where it's going to be opening up today, but I do think that this stock has great potential over here. I mean, if it pulls back to say the 470, 460 level, Glenn, I'd probably be a buyer of the thing. Larry says, you've been buying in the money puts at least the last few. Is this because of the cost or directional? What do you mean? Is that your normal at the money put? Again, remember the volatility has gone up and the cost of puts has become much more expensive, right? When volatility rises, the cost to insure becomes much more expensive because everybody's going after these puts. They're trying to protect themselves. And so when demand is strong, right, that's when the prices go up, right? When you have demand for a fur coat, there's only one fur coat there and you got 20 buyers coming in. Well, you could probably sell that for a lot more than what the price tag is listing. You get some people bidding higher for it. This is no different than what's happening with put options. So you asked me why I've been buying in the money puts. Well, because the out of the money puts are not that different in price than the out of the money. Larry, I want you to look at the SPY before the market opens. I want you to look at the SPY 298 300. I want you to look at the SPY 300 put that expired. All of you guys can do this. 300 put that expired on expires this Friday, 13th. The 297 put and the 292 put. I want you to see the difference in price for all three of those strikes. Okay. And again, you know what? We're not looking at expected move here. We know the expected move is extremely high. Okay. The expected move for puts and calls this week. I will give the expected move for the SPY is like $16. Okay. The volatility is 56%. But look at the Friday, right? So look at the Friday 300 put. Let's see here. So comparably speaking, I guess Larry's trying to wondering why I'm buying when I'm buying. 880 for the 300 put. 770 or 780 for the 297 put, 2.5 points down. The 292 put is $6. Okay, so that's $5 of room to get down to that strike. So again, repeating, the 300 was about 880. This 297.50, which was right at the money, was 780. Okay, and then the 292.50 was about $6. Right. I'm not paying attention to the flow right now. Just looking at the price because the price action matters the most to me right now, right? And I'm looking at the strikes and at the implied volatility. Okay, you see the difference there. From 292 at $6, the 300 is $8.80. So for a $2 difference, I can go in the money and have a little bit of protection with the intrinsic value. About $2 of would have about $2.50 of intrinsic value from 297 to 300, right? So why not buy that one? Again, you know what? We're not in the mood to try and be cheap here or inexpensive or what have you. Now, I obviously on Thursday I talked about and recognized a condition in the markets that was really odd, that the strangle and the puts and calls for that matter were rather cheap for the options that expired on Friday, on the 6th, right? I was really scratching my head. I was curious because we had a jobs report that came out. We still had all this coronavirus stuff going on, and it didn't seem that anybody was pricing in heavy volatility for the next day, right? So that's why we went a few strikes out of the money. I think the SPY closed at 305 or 304.5 on Thursday, and those 300 puts were only $2, $1.80, $1.90. I mean, the expected move was big. It was like $8. So why they were pricing so cheap, I couldn't really understand it. And so then we got that big move down on Friday, and we cut those puts off and rolled them to this week. So Rich is saying, if we currently have puts on hand, do you recommend selling puts 10 to 15 to 20 strikes below, taking a premium? Well, I mean, you could do that, but yeah, sure. I mean, absolutely. But but think about it. Think about this intuitively, Rich. Do you want to have a wide spread of puts open on the SPY, for instance, or in the DIA? I don't want to hold. I'd like to tighten that spread up a little bit. I'd like to put a little bit more cash in the account. If I want to hold that trade, if I don't want to roll it, okay. I don't want to have a lot of exposure to potential losses. If the market ramps up in your face, yes, those short puts are going to lose value. but your long put, your long strike is you're not going to have another. In other words, if you sell it 15 to 20 strikes down, let's say you're in the 300s, right? You go down to the 280s, right? You're not, the total net is not going to be 20 bucks. All right, it's going to be much less than that because there's going to be some time decay in there and some implied volatility as well too. So you're not going to get a whole lot for selling 10 to 20 points down because we're in an unusual situation where expected moves are much higher and much wider than they normally are. Make sense? Okay. All right, guys. Listen, I'm gonna hop. Let's get going. Let's have a good day today. All right. I'm here all day, obviously, as usual. David's with us as well. Everybody else, if you have any questions on anything, let me know. Let anybody know. Kindness is what it's all about here. And I know, some of us are hurting right now with a very, very difficult market. I think what we all need to do is just stick together, right? Take a deep breath, exhale, and keep our focus, move forward, and do the best we can, one day at a time, one trade at a time, 1 hour at a time. Okay, we'll get through this, and I don't think we're going to sit back and laugh about things, but I think what'll happen is we'll get through this all together. Thanks, guys. See you in the room in a little bit. I'll have this up on YouTube a little bit later on this morning. Thanks. Bye.